Hello, everyone. Welcome to our State of the Markets 2022 edition, where we're going to go through the markets from last year and also look ahead to next year, or it is next year. 2022 is upon us. So, before we get started, a little introduction. My name is Anthony Gerby, a financial advisor on the team with Stein Financial Group. There's me, baby faced without a beard. And I'm going to be leading you through today. And I will also be able to take any questions along the way that you would have. So I'm going to get the formalities, these disclosures out of the way. These are important for you to read, but without further ado, let's get started. Please, if you would, silence your cell phones. It'll just help make a better experience for everyone. And questions, as I said, are welcome. We are available. You can use the chat function, or we can wait till the end and you can ask a question. Anything that comes to mind, I will do my best to answer. So let's get started. Today's agenda is the following. What happened in 2021? That's the first bullet point. Why did it happen the way it happened in 2021? Or what drove the market performance, right? I'm speaking specifically about markets and investing. Where are we now? So where did that leave us, in other words? And what are we predicting for 2022? So those are all different things that we're going to cover here. And we're going to start with the first bullet point. What happened in 2021? Well, first off, and I'll move out of the way so you can see the numbers there, the S&P 500 closed at 4,766.18 points, which is a plus 26.89% growth for the year. Now, if you compare that to where the experts thought we would be, even with the COVID situation we had, it was much better. We were actually ended above even the most bullish analyst, which was in this case JP Morgan. So it was a great year last year, investing wise, despite all the things. Why did that happen? Well, we'll get into that. But one of the big things, obviously, was COVID vaccines. That was what led to some of these firms' optimism. And we actually even exceeded their optimistic projections. So, all in all, last year, the market did pretty well. And a lot of you may know that. So why did it do that? What went on to make that happen? Here's a little timeline from last year. It goes all the way back to January 20th. And as you can see, there's a steady move higher, not without its peaks and valleys, but a steady move higher. And the worst of which was a retreat in September. So this month of September, you can see kind of a downswing in the market there. And this is the S&P 500. So the S&P 500 is generally considered pretty representative of the U.S. stock market as a whole. So that's why we're using it here. And keep in mind, please, that past performance doesn't guarantee future results, and you can't invest directly in an index like this. This is just a sample that we're using to kind of see what happened with the market. So there's a few noteworthy points that I want to point out. First off, you can see the market was pretty choppy during the first quarter, but mid-March, where the U.S. crossed the landmark of 100 million vaccinated Americans, at that point, the sense was kind of beginning to grow that we had overcome the fits and starts in our vaccine rollout. And that, as far as the market goes, was a positive sign. So investors, we began to feel a little more confident and comfortable that the country was going to get to a place where the economy could sustain its growth momentum. Those were the big reasons why we had a good first to second quarter here. And not that there weren't scares, for sure. I mean, look at the middle of July, for example. More broadly, the month of September, as I already mentioned, the 1 day slide in July and the nearly 1 month slide in September were largely attributable to, you guessed it, COVID-19 and the different variants that were coming out. By the way, you see Delta variant. It almost feels like that's ancient history at this point. Do you even remember the Delta variant? So again, markets turned volatile at the close of the year a little bit. They slumped on the news of the Omicron variant the day after Thanksgiving. And then there was testimony by the Federal Reserve Chair, Jerome Powell, that he's considering accelerating the bond taper and all the way down the line. Bottom line is, as I listed at the very beginning, this chart goes up. And that's why we had a good year last year. This is representative, again, of the stock market. So again, we're on the question of, well, why did that happen? And one of the big reasons are corporate earnings. So corporate earnings are one of the primary determinants of stock price over the long term. And corporate earnings meaning how much money are companies making. So as the chart I'm showing you indicates, the corporate earnings came roaring back in 20 from their 2020 pandemic levels in 2021. And you can see that by the big up numbers on the right side of the graph here. So especially in the second quarter, there was a 25%, second quarter of 2021, 25% year over year jump. That's what's helping to drive a lot of this market growth. And that's normally how it works. When you see corporate earnings growth, that usually translates into stock market growth. Doesn't have to, there's no guarantee that it will, but that tends to be the trend. And that's what we're concerned with, is monitoring the trends here. So the economy, so getting away from the markets now, market versus economy. The stock market is traded on the New York Stock Exchange as well as other exchanges, but that is related to individual companies. What are they worth? What will you sell them for? What could you buy them for? The economy is based on all of us and our economic output. Are we going to work? Are we earning money? Are we producing things, goods and services? So the economy staged a really strong rebound in the first half of 2021. And as you can see by the GDP growth, GDP, by the way, stands for gross domestic product, which is, in other words, a measure of how productive we are, right? So the growth moderated a little bit in the third quarter due to a rise in COVID infections and the growing bottleneck in the supply chain, which we all know a ton about here. And many people anticipated a re-acceleration of GDP in the fourth quarter. Continuing supply chain problems might drag on that a bit. So we're looking for final numbers to come in there. And moving on from the economy or the productivity, what did the labor market do? So labor markets were a little bit slower to benefit from the economic reopening that we saw in early 2021, as you can see. The unemployment rate dropped sharply by the end of the third quarter, though, and that's what that labor market line is measuring, the unemployment rate. So the labor outlook continues to improve, and job openings, this won't surprise anyone, are exceeding the number of unemployed by quite a bit. There are many, many job openings right now. The third line on here is one that we've talked a ton about, and that's inflation, right? Inflation developed as a real concern as the year progressed, rising from, a modest 2.6% in March to 5.4% in September, with October and November, a 12-month inflation rate setting an even higher bar. So we're going to talk about inflation a little bit later, but that's definitely something we're watching. We've got consumer sentiment here. So consumer sentiment still on an upward trajectory. That's a good thing. Or it was on an upward trajectory, as you can see here, as American consumers felt better about the economic reopening and safer with the rollout of vaccines. However, during the surge of the Delta variant, and now as we're seeing the Omicron variant, it's waned a little bit, right? The fourth quarter number is the actual sentiment reading for November. So that's what they're using, the November piece. And it reflects, as you can see, kind of a downward slope in consumer outlook. So due to, and this is not just COVID related, it's due to rising inflation, the perception that policies have not been put in place to stop the inflation, perhaps. I mean, it's all these things kind of wrapped into one. And finally, housing. That was a huge topic. 2020 was the hottest year, but 2021 as well, it's continued. Anyone who's looked for a home recently knows how hot the housing market is. And home builders' optimism, which is kind of what we're measuring with that last line, was especially high in 2021. Not surprising, again, given low interest rates and the continued demand for homes being very high. So the number indicated is a survey of single-family home builders, their view of current conditions, 0 to 100 score. It's not going to surprise anybody to see that number be towards the higher end of its range, right? So where does that leave us? We talked about what happened. We talked about a little bit about why it happened. Where are we now? Well, these are my speedometers, and I'll get out of the way so you can see. Obviously, green would be a positive impact on investment. Or orange or yellow would be neutral, and your red would be potentially a negative risk on investment. So this is February of 2020. So I looked back first. This is not where we are right now. February of 2020, you can see from the spectrum of monetary policy all the way to geopolitical risk, what was in the green and what was in the orange, right? So I won't go through all of these individually, but there are a fair number of greens, about the same number of oranges, and then a couple reds. Okay, not too bad considering where we were at February 2020, right at the precipice of the pandemic. Where were we in November of 2020? Okay, well, compare the two. I'll go back and forth once. A few of the greens had turned orange, and a few of the oranges had turned red, right? What turned red? Well, disposable personal income and equity market valuation. Ironic, because equity market valuation means the stock market could be overpriced. That would be a worry potentially, which is crazy considering what happened in 2020 with the COVID, and we've already been through that, right? You can watch last year's state of the markets if you want to hear more about that. But we certainly weren't in as good of a position in November of 2020 as we were pre-pandemic, although it's not that far off either. So it was a huge shift over 2020. I don't need to say that more than once. Where were we just a couple months ago in December of 2021? Well, according to this same scale, same people who do it, we are in the green for almost all of the different sections, potentially set up for a positive impact on the markets. And that is, the colors speak for themselves. That's really good. 17 out of the 20 indicators are green, which suggests would be the word I would use, that the economy and markets are in a good position for 2022. Only 3 are flashing some warning signs right now, and obviously political environment, that hasn't been green for a while. Geopolitical risk, we can talk about some of the situations going on internationally right now, and equity market valuation, which was one of the ones that we were watching out for at the end of last year. So after the run up in values that we saw for 2021, this shouldn't come too much as a surprise. There aren't really any outright negative indicators here. And obviously that's a positive thing. So what are we kind of seeing? And leading economic indicators is what this chart is talking about. Let's dive a little deeper into, this is one of those speedometers in particular. So this indicator includes 10 components ranging from stock prices to manufacturing orders. And when examined together, it can give a little clearer view of where we are right now. So leading in economic indicators suggest that the economic expansion is trending higher into 2022, though supply chain bottlenecks can't be overlooked, no doubt about it, as a factor that might frustrate that outlook. You can still see a rise in the index of leading economic indicators, which is what we're looking at here, has never been followed by a recession. So that's encouraging. Again, that's a historical picture, but no model is flawless. So we're not going to take that to the bank. It's just something that has been a good sign in the past. So it's again, I'll say this 100 times, past performance doesn't guarantee future results. So we review charts like these because history can help suggest where we are in the economic cycle. But it's also important to remember that this is a forecast, and forecasts are never perfect, and they're based on assumptions. So those things can change over time. So those are my disclaimers here. What are our headwinds? What are the things that could cause us issues in 2022? I'll move out of the way here. So obviously the number one piece is still COVID. 2022, 2 years after the onset of the pandemic, it is still COVID that could cause headwinds here. Inflation is a huge challenge, right? As higher prices might sap some of our spending power throughout the year. So we're going to take a deeper dive into inflation a little bit later. The Federal Reserve policy pivot. So at the end of last year, if you didn't hear, the Fed announced it'd be quickening the pace of its wind down of its monthly bond purchases and signaled 3 potential interest rate rises in 2022. This has been in the past. So the Fed's policies were a big part of the puzzle of why stock prices went up. So them kind of changing course as a result of this inflation could be a headwind for the stock market. That's what we're kind of looking at. However, the Fed is looking to return actually to a more normalized policy amid a healthy economy, a rebounding labor market, and accelerated inflation. So it's uncertain how this is going to actually play out. This is one of the times where I'll say, stay tuned, right? We did see, by the way, an example of this at the beginning of the year. Think back to January, when the minutes of the Federal Reserve's meetings, if you don't follow those as closely as we do, I'll forgive you. But it indicated that a rate hike might come sooner than expected, which led to a sell-off in the market. Okay, that can happen when they change policy or when they do something quicker than expected. But one result of higher rates may be a reevaluation of stock prices to reflect higher interest rates. And that can be a double-edged sword. I'd have to take another hour just to dig into that topic specifically. But so the Fed policy is going to be a huge piece. China's slowing growth. So China's in the news because we have the Olympics going on. But as 2021 came to a close, there were early indications of slowing economic growth in China, in a large part due to its zero COVID policy that shut down whole cities at the first report of infections. So as its wealth has grown, China has actually become an increasingly larger importer, not exporter, but importer of foreign consumer goods and raw materials. And any reduction in that demand can be a drag on a wide range of companies globally. So this is something we need to watch as it affects the world market. Midterm elections, all right? It's going to create a little uncertainty. Probably enough said there. We all know those are happening this year in 2022. And geopolitical tensions. Okay, we can talk about Russia and Ukraine. We can talk about China and Taiwan. And Russia's leverage over Europe's energy supply is one of the big pieces at stake here. That's one of the things, fortunately or unfortunately, hopefully this plays out in a way that's good for everyone. But we're just going to have to keep watching to see how things happen. So those were headwinds. Well, let's talk about what could be going well for us. What are our tailwinds here? And the tailwinds, just to read, economic expansion. So the economy is expected to expand in 2022. And maybe I should have led this whole presentation with that, right? The level at which economic growth serves to propel markets higher, of course, will be a function of how healthy that growth is. Let me put that another way. How big or how fast the growth is that the economy experiences will change how it affects the market, how much, the magnitude, or just the extent or the length of the market. So again, no one has a crystal ball, no one knows for sure, but the economic expansion tends to be a tailwind. Continued monetary accommodation. So we just spent a bunch of time talking about the Federal Reserve. And even though it's reducing its monthly bond purchases, they're not expected to end until June or July. So actually, the Fed is indicating, and aside from that, the Fed has indicated that any rate hikes will actually be in the year's second half, although they've talked about doing one in the first half. So we've kind of baked that into some assumptions, but they haven't solidified that plan yet. So the takeaway here, bottom line, is that the monetary policy from the Federal Reserve remains fairly accommodative, even though they're kind of going off of the pure wide open stimulus that we saw in 2020 and 2021. So we talked about corporate profits. They were solid in 2021, and provided that they continue to expand in 2022, this could justify that high market valuation that we see in the market. So, we're looking for positive things there. And finally, the healthy consumer. So are we able to go out and buy the things we want to buy, have the money disposably to not only take care of the necessities, but also to live maybe somewhat closely to how we were living pre-pandemic? And the consumer, from all our data, does appear healthy. Net worth on average has grown actually from pre-pandemic levels. And financially strong consumers should actually continue to support further consumer demand for goods and services. So there is one important caveat there, which is consumer confidence is actually a little bit lower owing to the rise in inflation mostly. And watching the cost of basic consumer goods like food and energy, those with inflation may start to take up a bigger and bigger piece of a personal budget, for example. So that can weigh down on just psychologically, if you're paying more for your food and your gas, for example, than normal. That can weigh down. So it's important we see how this plays out. But in general, the healthy consumer can be a good tailwind here. So Before we move on to our discussion of our forecast for next year, just to see where we are again right now, look at this chart, which is the S&P 500 valuations. So where, basically, in other words, where are stock prices versus their historical averages? Well, if I move myself, we get to the end of 2021 here, October 31st, 2021, we are sitting at a high point. Now, since October, as you may know, in January, the market has dropped a decent amount. So this valuation is not as high as it once was in October when this chart ends. But that does not change the fact that our equity market valuations reached historical highs in 2021. And what that means, it doesn't mean anything by itself, but it's higher than average. And some people could look at that and say, wow, I think we might be due to return to that average. Again, it's something we're going to watch very closely, but it's not something that signals a trend one way or the other. It's just another data point that we use as we try to figure out where we are and B, where we might be going. So we're going to talk about 2022 forecasts right now. This is, again, probably what you all want to know. Where are we headed in 2022? Okay, well, nobody has a crystal ball, but let's look at what we look at to try to make that determination. So I mentioned that the healthy consumer might be a tailwind or a good thing for the market this year. Here's why. So the share of GDP, again, our productivity as a country, that comes from spending within the US, our personal consumer spending is about 70%. In other words, our spending is about 70% of our economy. If we as consumers are healthy and able to spend money, that will contribute to economic growth. That's just how it's worked in the past. So this chart is actually an illustration of balance sheets of Americans coming into the new year. And as you can see, assets owned by individuals have steadily risen since the depths of the pandemic in the second quarter of 2020. The chart is trending upward, in other words. And it's now higher than even pre-pandemic levels, the assets. Meanwhile, consumer debt, not government debt, consumer debt has stayed roughly the same through this same period, owing in part to government assistance programs throughout the pandemic period. So it helped keep consumer debt in check. That's what we're talking about, consumer debt. When taken together, Americans' net worth has increased, which has put more spending power into our hands as consumers, which may lead to higher economic activity. There is one more important element, though, to increase spending, besides just having the money to spend: confidence in the future, right? So we need to be confident in the future to be willing to spend money for the future. So in the past 2 years, we've seen that consumers who lack confidence in the near-term health of the economy or are concerned about the spread of COVID infections are less likely to spend. And because of some of these variants we've had, consumer confidence took a hit in 2021. So that's kind of a mixed bag. We'll have to see where this kind of shakes out here. So quarterly periods and earnings growth percentage increases. So this is now, we're talking about corporate earnings again, which might seem like a dry topic, but it's incredibly important when it comes to how the market works and what we might predict for the future. Corporate earnings are likely going to be another important determinant of stock performance in 2022, no doubt about it. 2021, as we already saw, earnings were strong. They were actually rebounding strongly from very muted earnings during the pandemic months in 2020. Again, that's exactly what we would have expected. So as you can see from the chart, and I'll move my picture a little bit so you can read there. The third quarter of 2021 was exceptionally strong. So it increased 39.8%. That is a big number. And fourth quarter earnings are expected to be over 20%. So these are big numbers that are not expected to be repeated. Don't expect this to just continue in perpetuity, where our companies are making that much more money year over year than they were the year before. So in fact, this year, earnings growth estimates are expected to narrow with, our estimates are a 2022 calendar year growth rate of just under 9%. And at first glance, that might seem like a headwind rather than a tailwind for the markets, right? It's much lower than it was in 2021. But remember, markets are discounting mechanisms that look 6 to 9 months ahead. Okay, That was a fancy way of saying it. The easier way of saying it is the markets are trying to look 6 to 9 to 12 months, for example, ahead. So we're factoring in the idea that corporate earnings may not be as strong, most likely will not be as strong as they were in 2021. So today's prices are reflective of the 2022 forecast for corporate earnings, not what we just saw in the past, right? There is a forward-looking perspective there. So a strong economy in 2022 could lay the groundwork for positive earnings surprises this year, and that's usually a good thing. So we're looking, certainly we're hoping for that to happen. And it's important to remember that forecasts or forward-looking statements are based on assumptions, subject to revision without notice. You can tell I'm in disclaimer mode here. And it may not materialize like we've predicted. That goes without saying for any prediction. We're doing our best to kind of read the trends here, but things change. So we need to be attentive to that. All right, inflation. I promised that we were going to talk about it more. Here we go. So inflation is an incredibly important economic indicator because rising prices impact the entire economy. Too much inflation can actually hinder growth, while too little can be a sign of weakness. So you got to kind of try to hit that sweet spot, right? As this chart indicates, I'll move over to the side here so you can see all the way through October. Inflation took a sharp turn higher last year, no doubt about it, from the norms of the recent decades. It was strong rebound from pandemic induced recession, coupled with labor shortages and supply chain bottlenecks, and many things got more expensive. Some economists point to the combination of fiscal spending and accommodative monetary policy as contributing factors to the acceleration of inflation. Okay, that was more for me than for you. That's what I'm interested in. But it doesn't matter what the reason is. Inflation has accelerated at a faster pace and persisted for much longer than originally anticipated by the Federal Reserve. Federal Reserve Chairman Jerome Powell has admitted as much, and despite this admission, Powell still believes inflation will recede in 2022, and the market has largely accepted this inflation narrative. While unclogging the supply chain pipes will be a key development in 2022 to moderate the inflation, that's why it's key. Wage growth pressures are likely to persist as a driver of continued inflation in this new year. So the real answer is we'll see, right? The Federal Reserve Chairman has said this inflation probably is transitory. That's their opinion, and the market seems to be going along with that. And I think that's a very well-founded opinion. But no one really knows until we get there. And that's kind of what we're saying is we got to wait and see here. So we also included the rise in producer prices. So there's consumer price index and producer price index. And they're exactly what they sound like. Consumers price index reflect the prices that consumers face. Producer price index reflects the prices that producers face when they're buying, for example, raw materials or inputs for what they're producing, let's say. So no doubt about it, inflation may have a major influence on the performance of financial markets in 2022, since it could force the Federal Reserve to quicken the pace of its bond tapering program and change its plans for interest rates. I mean, change of plans, unexpected things makes the market potentially a little more unstable. That's why we're watching it very closely here. So even if the Fed sticks to its schedule for tapering and bond interest rate hikes, the bond market may not sit idly by. Bond investors actually might demand higher yields to offset the rising inflation, right? If your bond is earning 3%, but inflation's at 4%, you're going to want a bond that's at least earning 4% to keep up, right? That's what they're saying. So the effects of which could ripple into the stock market, especially among high valuation companies. I'm using a lot of coulds and maybes because how this plays out will be the story of 2022, but that story has not been written yet. So if that's one thing you can take away here, it's something we're watching very closely. COVID, no doubt about it, is going to be a huge factor continuing in 2022. So during the past 2 years, there's been no greater influence on stock market than COVID, at least short term. Increases in infections raise the prospect of economic restrictions, causing sell-offs, all the way down the line. We kind of know how this world works now. And here are the daily confirmed new cases of COVID-19, 7-day moving average. So you can see the latest spike in the US due to the Omicron variant. You can see other countries also experiencing a more recent spike at the end of 2021. And then we can look back all the way to 2020 when we had the big peaks of infection. So where this goes is going to be a huge determinant on the markets, because if we see another spike, then the market may react to that. So it's just something, again, we're going to have to keep monitoring as things go on, as time moves on, I should say. So what are we predicting for 2022 as far as economic growth? So these economic forecasters were surveyed by the Philadelphia Federal Reserve and are painting the picture of a generally improving economy. So they've trimmed actually a little bit their GDP growth estimates for the final quarter of 2021 and the first quarter of 2022, but they are projecting stronger growth in the second half of 2022 than originally anticipated. So overall, we are predicting a positive year economically speaking. Maybe not quite as good as 2021 was when we were still recovering from 2020, but still a positive year. And on the labor front, very optimistic actually. And they're saying we may get down to 3.9% unemployment, which is a very low rate by the end of 2022. Again, forecasted numbers, but positive numbers. And that's a good sign, no doubt about it. So unemployment and wages, I'm going to move out of the way here again. The labor market continued to strengthen over the course of 2021, with unemployment falling and wage growth accelerating. It's hard to find people to work versus being hard to find jobs, right? It's kind of a good problem to have, but it's still a problem, right? So as we saw in the previous slide, unemployment is actually expected to fall even further as the economy expands, and a healthy employment picture has historically meant well for the economy, right? That's been a good thing. Wage growth is generally a positive development for the economy. It should be noted, this is important, that this upswing in wages has been offset by the inflation that we've seen. So leaving many workers with the same or potentially even lower spending power, because if prices are rising faster than you're getting raises, well, you're kind of just treading water, right? So that's happened to a lot of people. What we've got here is, you can see, if I were just to look at this historically, wage growth and unemployment rates tend to move in cycles, and they tend to move opposite each other, right? If the unemployment rate goes up, there are more people unemployed, wage growth goes down, right? And when unemployment goes down, wage growth goes up. And we seem to be at a point where we're, again, COVID threw a big spike into this graph, but we seem to be at a point where they're converging again like they have previously. So the market forecast, S&P 500, which is not the total stock market, is the 500 largest companies in the stock market. It's an index that tracks those. But what are the predictions? Here they are. So on average, experts are predicting a modest gain from the 2021 close, right? A modest gain. The forecast reflects the belief that stocks are unlikely to repeat their outsized gains of 2021, as well as some headwinds that may impact corporate earnings and economic growth, such as inflation, supply chain disruptions, and potential for new COVID-19 variants. Can't ignore that possibility. So within this average forecast is a broad range of estimates, right? You've got Wells Fargo being the most optimistic, and then you've got Morgan Stanley being the most pessimistic. And if you average all those out, you get to the bottom, the purple bar, and that is a positive growth. But there are predictions on all parts of the spectrum. So obviously no one knows. We're going to have to see where this plays out. But in general, the average predictor, if you go by these companies, is predicting a positive shift for the market in 2022. So this is nothing to do with 2022. This is just a great slide. I mean, it has something to do with 2022, but this is an incredibly important piece. And what this is it shows the returns of stocks, bonds, and a 50-50 mix of stocks and bonds over a 1-year period, over a 5-year period, over a 10-year period, over a 20-year period, going back to 1950. So pick any, if you're looking at the 20 years, any 20-year slice of that time frame, or the 1-year period, pick any 1-year slice of that time. What is the range of returns that you could have experienced? Well, in a 1-year slice, look at the range on stocks, the darker blue line. You could be anywhere from an up 47%, which was the best 1 year period, or down 39%, which was the worst 1 year period. That's a huge range. Bonds, for example, have had great up years, and we're thinking of like the 80s, for example, being great times of returns for bonds, and they have a much lower downside than stocks have in a 1 year period. And a 50-50 mix, as you would expect, is a good balance between the two of them. That lower downside, actually in this case, a little bit lower upside for a 1 year period. But go out to the 5, the 10, and the 20, and now you see the power of diversification. Because let's just look at the 5 year. Yes, stocks still had the biggest upside. They do in all the periods, no doubt. They also had the biggest downside, and that is true in all the different periods. Now, the 20-year rolling, the bond pieces, part of that's because bond values have been much lower than they were, again, in the 80s and 90s. Those were kind of, as we look at it now, outlier years. But this really shows the value not just of diversification, but also the power of staying invested over those time periods. And that's something, you'll hear me talk about a ton. What is the value of staying invested? Well, over the long term, you get to experience things more like the right side of this chart than the left side. And that's a big deal for our long-term planning. So what steps are there for you to take? Well, obviously, please keep us in the loop. As things change with you, let us know so we can take that into account as we're planning for you. Tell us about the concerns you have. I am never sad to get a phone call of someone who's got what they even think is a simple question, right? I'm never upset to say, yep, let me tell you exactly what that means on your statement. Or, hey, Anthony, what are you thinking about the markets? Well, I might point you to this video too, but I'm more than happy to give you my thoughts. Please, if you're thinking about it, if you want an answer, that's what we're here for. So please get in touch with us. And finally, and I'll say this anytime, always, keep your legal and financial documents up to date. Wills, trusts, if that's a good option for you, healthcare directives, making sure your beneficiaries are up to date. We can help with that. Even things that we don't do directly, we have great partners who we could refer you to or who we could give you as an option. So those things are incredibly important to keep up to date. Steps for us to take. This is what we're going to be doing for you. We're going to keep you informed. This is part of our regular communication. We want you to know what we're thinking. We're going to manage your investments according to your personalized strategy. It's not what Anthony thinks is best. It's what Anthony thinks is best for you that we take into account, because your situation is different than the other people we might work for, and their situation is different from yours. So we need to do this on a personalized basis. We're going to stay on top of the changes in the market and make adjustments where necessary. So this is, again, part of what we're talking about today. We are staying on top of the news so that we can take new developing events into account when we're looking at your accounts. All right. You've been very patient with me. Thank you very much for listening to all of that information. This is really stuff that I love. What questions do you have for me? And with that, I will end the presentation, and thank you everybody for being here. We will see you next time.